Stock selection is obviously quite a difficult task. And we study a number of quantitative models that help us in this difficult task. And the question is, when we're done with our models, what does this mean in terms of market efficiency? Suppose it's the case that I estimate my cross-sectional regression model, or I've got a multivariate sorting strategy, or look at a number of firm-specific characteristics, and come up with a strategy that delivers a consistent spread between my buy portfolio and my sell portfolio. Does this mean the market's inefficient? Well, this is my view. First, markets are inefficient. That is very clear, and nobody, I believe, would disagree that markets are inefficient. The real question is how inefficient they actually are. And there's a big difference between trading in the US market and trading in a market, for example, in an emerging market. So efficiency is really a relative concept. Efficiency is how quickly information is incorporated into asset prices. And I guess I also believe in the fundamental foundations of finance, that there is a trade-off between risk and expected return. And indeed, if I see that there's a very high expected return, the first thing I think is, well, this must be riskier than something else. The problem is that we don't have the models for sure to know what the risk factors are and how much the ex-ante risk actually is. So you could actually view what we do in stock selection as a methodology that perhaps is somehow proxying for risk, but we don't actually know what the risk model is. Let me try to rephrase that a little bit. That it's likely that the difference between the buy portfolio and the sell portfolio has something to do with risk, but the models that we're using don't explain all of the difference in the expected returns. So some of it is risk, except we just can't tell for sure because we don't have the correct models. Now, if you don't have the correct models, one approach would be to say, well, we just can't identify any portfolios for investment in. Well, it's not my approach. My approach is to go to the data and figure out what you can do to get the best expected return to risk, in quotations here, risk defined in the context of the models that we know. Now, part of it can be explained by risk, but not all of it. And part of the idea of us applying these quantitative models to portfolio strategies is that there are many investors out there, each with perhaps different information sets, each weighing individual pieces of information differently, and each having their own degree of forecast accuracy. What we endeavor to do is to develop models that perform better than average. If we can take a complex set of information and apply weights that are better than the usual weights that are applied in the marketplace, then we're going to have an edge. It's like an informational edge. When you trade with somebody that has inside information on a particular firm, and I don't mean illegal inside information, but just like better, higher quality information on a particular firm, then you're likely to lose on average. Well, you can view this the same way. We've got potentially expensive information that we're using. We have carefully calibrated our model Our model is sophisticated, it is flexible, it is tested out of sample. It is not the technology that most people would be using. And we can use this model to win. We're not going to win all the time, but we're going to win most of the time. And in doing that, we use the quantitative tools to produce a return that's different than the average return, different than the benchmark return. We deliver, according to the traditional models, a positive alpha. Is it really a positive alpha? Maybe it is, but probably part of that alpha is due to our inability to identify all of the risks. Nevertheless, it's kind of an academic question. What we want to do is to design models that are able to produce a positive spread between buy portfolios and sell portfolios, and a consistent spread. And perhaps the most important thing in designing these models, they cannot be static models. The people learn what you're doing. You constantly have to be allocating funds towards research in developing an even better model.